Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. We're going to do a 2024 review, 2025 preview show. It is Thursday. I almost said 2024. It is Thursday, January 9th, 2025, with the founder and president of Leduc Trading, Samantha Leduc. Thank you for joining me again.
Oh, thank you so much, Jason, and Happy New Year.
Happy New Year to you as well. It's been a really interesting last couple months here with all the craziness going on throughout the holidays with the election. I want to get your thoughts, though, on 2024 first before we talk about 2025. Were there any major surprises in markets that you didn't see coming that surprised you about 2024?
Not as much, but right now I think 2025 is going to be filled with them. So 2023, on November, we had our last really big policy intervention. I referred to it when we met last in June of last year as the Fed pause and Yellen Yahtzee. So that meant on November 1st, Fed announced that they would be pausing, and that helped put a bid underneath equities, both from short covering, but also just all the animal spirits, right? So we had already had excitement from, May 2023, Nvidia earnings. We already had the bank backstop in March of 2023. So we had already some momentum going into the year after a very hard 2022, right? So NASDAQ fell 35%, SPY 20%, but 2023 started off slowly. Then we had the bank crisis. Then we had Nvidia earnings and all things AI. But it really wasn't until November 1st, when the Fed came out and said they were going to pause, and Yellen issued a lot of short duration bills, which, by the way, she's being criticized for by the new head of Treasury, appointed Scott Bessent. So the combo deal of this collaboration, repeatedly, by the way, by Fed and Treasury, Powell and Yellen, has been the reason for the season in why our equity advance has been so supported. It's more than the Fed put. It's how Yellen finances this growing fiscal deficit, right? So it really has been from the COVID lows, both the monetary easing, the fiscal stimulus, and then the continued policy intervention. And they have been very much in coordination with the Bank of Japan as well, from October 2022, when the gilt blowout occurred, which was really also at the same time the Bank of Japan was doing a yen intervention for the first time in 24 years, but unapproved by the powers that be in the U.S. So it was a combo deal in October of 2022. You can point to the charts. You can see where bond bulls got defended. You can see where equity markets got defended. And then you can look to October, November 1st, 2023, and you can see once again, bond bulls got defended and equity markets rose. So because we have this coordinated, policy intervention, it was easier to trade. In a nutshell, you need that. That's one of the legs. I call it the three legs of the table. You need the policy intervention, and then you need liquidity. Liquidity is this, it's not just central bank Fed balance sheet, but it's also refinancing. So if you take a look at September of 2024, for example, there was very large corporate debt issuance, and financing was very positive, and that helped for the yield, the high yield OAS, which is the credit spreads, to tighten, and equity markets loved that. And then you get into the Trump bump, right? That election of November 5th, and we've gone sideways for 2 months. But the point is, every time that we have the combination of policy intervention with liquidity, we have an absolute bullish market. It's very, very obvious also because option flow starts coming in aggressively bullish, and then it starts feeding on itself, right? The buying begets buying, and the dealer activity, which is something that I also follow closely, which is the quant side of it, is all part and parcel for what is continuing this bull advance for 2023 and 2024. If you look at the NASDAQ, the lows of January into the close of the election result, right, with this gap up, It was a 100% return for NASDAQ 100, led in large part by the Mag 7. So you've got this concentration risk, you've got policy intervention, you've got liquidity in abundance, and you have a very, very bullish option flow that is the reason for the season. And now enter 2025, and we have no bloody idea what's coming, meaning this is not 2017, where Trump was coming in and able to, feel his way through with policies and trade wars in a monetary dominance backdrop. We are in fiscal dominance now. So it's a very different environment. So we don't know what the policies are really going to look like. Are tariffs going to be slowly rolled out or quickly? The dollar is a huge deal. We're going to talk about the dollar. We're going to talk about the yields. We're going to talk about tariffs because that will impact 2025 policies, and policies will dictate price. And I think there's going to be a lot of surprises in 2025. We don't have Yellen anymore. We have basically Besant, who wants to shadow Fed Powell to kind of, squash that entity. So we don't have a coordinated Treasury and Fed anymore. We don't know what the policies really are going to be. And the market doesn't like that indecision. And that's why for the past 2 months, we have gone sideways, nowhere fast. So I think 2025 is going to create a lot of surprises. That was a long answer to your question. Did you have any surprises in 2023? The one thing that I said.
You mean 2024? Yeah.
2024. Thank you. The one thing that I said in November, after I realized the November 1st Fed pause in Yellen Yahtzee, it was on November 16th, I said, we have a risk of a 1999-esque ramp in equities. Or 1995. I was like, I know it's bullish. I know they're going to tap down dollar and yields, but I'm not quite sure, which we're going to get. We really did have a slow grind higher. So we didn't have that euphoria, thank goodness, because that would have been very destabilizing sooner. But we definitely had concentration risk, Mag 7. We definitely had US dollar weakness right after that November 1st, 2023 Fed pause in Yellen Yahtzee. And I really, this is the reason for the season as well. As the dollar falls, it helps support equities. That headwind right now that they're facing in Q4 is going to come out in their earnings next quarter, not now, not the earnings that are about to report. But I'm talking about the fact that we have had now a very strong dollar relative to peers. I'm talking nominal. It's very strong, right? Overvalued, many would say. We've also had rising yields. And just recently, we've had rising oil. All three of those are headwinds to earnings. We haven't had that. They haven't been in the way. So now that's going to have to get priced in because currency conversion for companies that derive revenue abroad, it takes a hit to the bottom line. Energy costs rising take a hit to the bottom line. Refinancing costs because of higher rates take a hit to the bottom line. So there's going to be a different environment moving forward. And I think that was the biggest advantage is that you don't really have to be smart to trade a bull market. But I don't think we're going to have a bull market in 2025. And I know that is counter to many, many, many on Wall Street. But again, I'm not from Wall Street. I use my own, sense of macro and motivations with intermarket and technical, with, quant and sentiment. And it does not read to me at all bullish for the second half of 2025. In fact, I think we're going to pull forward recession risk. And this is something that I talked with you last in June. I said I saw one more high. Remember that? That was very important. I did not think the market was done. We were gripped with a yen carry trade unwind. But after that, I said, I think we're going to have one more high. And then I think the second half of 2025, we're going to pull forward recession risk. And I still see it. Nothing's changed.
Oh, so you're talking about the real economy then. I mean, I would argue that outside the United States, like on a relative basis, the U.S. economy is still doing better than a lot of other areas like the European Union, emerging markets, China. Japan, a lot of other different countries or economic blocs. But the asset markets, it seems, Samantha, really since the summer, I think the other central banks, like the Bank of England started first, European central banks, they started a rate cutting cycle. And it seems the liquidity or the other programs they did, a lot of that managed money, the institutional investors, they decided they didn't like their domestic economies and they just kept buying more US stocks. Is that what you saw with like the liquidity and the fund flows?
That is the result of it, yes. So I would say that to that point, it's very, very true. We have really a global, except for Japan, we have a backdrop of global central banks cutting. And that is because, or it's part and parcel, the definition of global credit demand is falling. So that's the first thing. And the devaluation or the competitive devaluation that's going on because of the strength of the dollar is kind of masking, like you just talked about, the real economy. And we haven't seen that here. The economic data, for the most part, if it can be believed, has shown real strength. For example, jobless claims, unemployment rate, we're still in the low fours. That hasn't really upset the apple cart, so to speak. I think it will. I think especially now that we have, this Department of Government Efficiency proposed, but the point is there's more talk about deficit cutting, streamlining efficiency. And I know you're in DC area, and I know you think this is gonna, what do you call it? They're talking to the wall, but but they really are.
It's hard. It's going to be harder than they think. And I haven't even heard. I mean, I've heard rumors that they're thinking of using artificial intelligence software to be like kind of the employees for the Department of Government Efficiency and just hiring computer programmers and software to do a lot of this stuff.
Well, there will be a discussion that we have also about AI. I mean, it was banks are expecting to cut 200,000 jobs by such and such year because of AI efficiencies. Well, what about all the other industries? So we definitely, my point is, are getting to a level in right now where we have not been affected by rising jobless claims or unemployment rate. I think it's coming. So and it isn't AI per se. That's a future kind of deflation area to debate, and that's not mine. I'm talking about for next year. I am seeing the recession worries will be pulled forward because jobless claims will spike, unemployment rate will spike, and this is against the backdrop of sticky inflation, where we still have a global credit. A global cutting cycle. Fed has still, intentions to do the same here locally. And then on top of all of that, we have this trifecta when it comes to kind of recession risk, right? Which is global credit demand is falling, and that will show up in a lagged effect to the real economy. Jobs have, if we believe the BLS data in the US, have been weakening. In other words, continuous claims are rising and hiring is less and, but that's not what I'm nitpicking about. I really am looking also at the fact that all of our yield curves from 3 months to 30 year have gone positive. Now, most are focused when they look at yield curves as we disinvert, we go negative, and then it's recession risk. Oh, no. It's actually when it comes out. So we've been for 2 years.
So you're talking when let me make sure our listeners understand. So you're talking about when the yield curve goes from inverted, and it was inverted a record amount, a couple of years, right? Like 24 months or something like that, a record amount of yield curve inversion. You're saying when the yield curve goes from inverted to uninverted, a steepening yield curve, you're saying that signals recession then?
Yes, it's not, it's a timing trigger. So in other words, it comes out of negative and it goes positive. So it disinverts, and one by one, the curves from the 2 and 10 year, which is the most popular, right, to the 3 month to 30 year. Then this disinversion, it starts to pick up speed. This is what's happening right now. We're having what's called the bear steepener in the 10 year and 2 year yield curve. And you can see the 10 year is also picking up. And even though, global central banks are cutting, yields are rising. So this is where we start the clock. It could be 3 months, it could be 4 months, but typically within 6 months after this disinversion, across the curves that have gone from negative to positive, you can start counting when they're going to pull forward recession risk. When we could go into recession risk, or they're going to start talking about it, and then it becomes a self-fulfilling, right? In other words, nobody's really shedding jobs right now. They're not hiring as much, but they're definitely not shedding jobs at a rate that would worry the real economy and all the economists who, by the way, across the board are saying there is a zero recession risk in 2025. I'm looking at what I just shared, which is the global credit demand falling. I believe jobless claims and unemployment rates spiking. I absolutely see this clock ticking on the yield curve, bear steepening. And we have got a concentration risk in equities that is unsustainable. We have a dollar that is overvalued relative to peers, and they're hoping that Trump can pull it down, but it's going to be very, very hard to do that. And we can talk about the reasons why he's really in a tight spot because of the particular policies are very dollar bullish, like across the board. So a rising dollar, again, is a headwind, right, to multiples. And this will force, I believe, some repricing, de-risking and repricing that has not happened with the Mag 7, for example. But if you look underneath the surface, if you only look at SPY 493, the 493 companies, not the top 7, they only returned 5+% last year versus the 23%, where the Mag 7 returned 53%. It's a very different market underneath the surface. So that will come to roost. In other words, that breadth breakdown underneath the surface is being disguised by the strength of the Magnificent Seven or the balance sheet heroes, the ones that are not so affected by rising yields, right? They don't have to refinance. They don't have to turn over their debt like 50% of the Russell. So this is a very
because they refinance close to zero during the pandemic,
exactly.
Like 2020 and 20. ExxonMobil, I think, issued a record amount of debt, and now they cleared a lot of it at the higher oil prices, and they locked in a lower rate. But there were other large companies that did the same thing.
But also the money that's coming from abroad, where is it going? Into the dollar to buy equities that are safest, and so it's really a defense play. So there's a lot of money that's going in to big tech. Again, also pulling forward all kinds of excitement around AI and now even quantum. But it has its dangers. It's not quite ready. I mean, even Jensen Tuesday night or whatever at the CES event turned to his CFO and said, yeah, quantum's about 15, 30 years away. And then that dumped. I saw quantum plays. Oh my God, it was like we're talking 30, 40, 50% in a New York minute. Those unprofitable tech plays that said quantum on them with a 230 forward PE dumped. So this is the market we're in. It's very speculative, but it's hopeful, and I think that's a little bit too much hopium in this market. And I think you also know that if Trump is successful in any way, shape, or form in getting some of these cuts through Congress, and in fact, deflating the deficit, it's going to hit very hard to company margins. And that's also going to hit the labor market. It's labor shedding. So I think we're gonna have a lot more surprises in 2025. 2024 was easy by comparison.
So you would say base case then, very high probability, you said, towards the second half of 2025 then of a recession, but you think then most of the factors are global macroeconomy and a strong dollar, or do you think then it'll be US centric?
Oh, I'm talking about the US, but it will have an effect elsewhere. But I mean, this is definitely a US centric recession call that obviously will affect the world.
Well, I think we were talking before I started recording, I think the global economy is already softer in a recession. So I think the US on a relative basis was doing better the last couple of years. But now I think eventually that was going to catch up because the rest of the global economy, you can't just keep having all the capital flows with the central banks cutting interest rates and all the capital coming here if the real economy in those other countries are not doing well. we have a lot of multinational selling stuff, right, to other countries. Is if their sales are going down and their costs are going up with labor and energy and stuff like that, then they're not going to have good profit margins. So eventually that was going to hurt them.
Yeah, we haven't even talked about tariffs because we don't know how this is going to get rolled out, right? Is it going to be an economic emergency, which is what he kind of tweeted on Tuesday, or are they going to be slow and gradual so that the countries can manage their currency impact on their consumers? So this is to be determined. But there are some levers that Trump can pull. One of them is US dollar devaluation as a policy. So let me just talk a little bit about that, because this will have, I think, will make the weather as it relates to, good or bad or, terrible. But if, for example, and right now it's a kind of a dollar manipulation game where we really, really need for the US government to shrink the deficit. But that would require austerity. That's the right thing to do, but will they do it? And it's not about political expediency. It's about, oh my God, the hit to the market and the economy. I don't know if they're really willing to put in that short-term pain for long-term gain, but it would definitely also trigger volatility, right? Higher employment, pull recession risk forward. So one lever that they could use to offset is use the dollar, tap it down slowly. We don't want any fast devaluation. We don't want a forced devaluation. That's not a high probability, by the way, where the US leads a dollar devaluation like China did in 2015 for the yuan. This is not my baseline bet. But the dollar could fall if Trump ends the war in Ukraine, for example, and that supports the euro. That's a bullish backdrop for equities. In the reverse, if Trump escalates things with Iran, that just bids up the dollar, right? That's the safety trade. So if there's a lever, if peace is in the future, then that can lead to the following. That can help the dollar fall relative to the euro and U.S. yields to fall if part of that peace deal, even if it's forced down Ukraine's throat, even it would help if Russian seized assets by the U.S. Treasury are returned, something that Trump has alluded to. So you can already kind of see where there's a peace trade. And I'm kind of like nervous about even suggesting it, because the other side of that is lots of war vibes are still percolating. So this is going to be tough to pull off. But nonetheless, it would be very helpful to the dollar and U.S. yields if this type of scenario played out. And that would also allow the Fed to proceed towards their route of normalization of rate cuts. And that would be net bullish for bonds. And right now, bonds are continuing to fall apart, right? So that's one area is dollar devaluation, peace trade. I'm not talking a forced one, but we need to do something, or I should say he needs to pull some lever. Otherwise, we're going to start to come into kind of a bond duration shock again, like we did in 2022. So this is where yields are still rising, and that's not good for the U.S. real economy. They're hurt by that. Yields, dollar. And so if we kind of look at this with a plan that Trump has a way through tariff deployment and dollar weakening because it's very overvalued, then we could actually be okay. We could go sideways. That would be actually my preferred, because if the market gets too excited, then we're going to have that kind of parabolic advance and crash, and we're already extended by every measure. So the best I think we can hope for is some type of gradual tamping down of dollar and U.S. yields. Otherwise, all bets are off. We will most likely have another bond duration shock or recession risk.
Do you think that the Federal Reserve Bank, the PhD economists there, are panicking now? Because do you think they screwed up the rate cuts a couple months ago with the 50 basis point and the other 25 basis point follow-up rate cuts, so 75 basis points of rate cuts, and now they're seeing what the 10-year U.S. Treasury, it's almost at 4.7%. It's rallied. The yields have rallied back up. And then the other worrisome one is the 30-year U.S. Treasury. I mean, that's going to start to really hurt the real estate market soon. 7% 7%, over 7% mortgage, even if you have a perfect credit score on a 30-year mortgage now, the average person just can't afford that with the payments because their income's not rising to offset the mortgage payments.
So this is interesting. Actually, I made a call, very public on my Twitter, and my clients know, of course, on the pre-market of September 18th, and literally big capital letters, time for a yield spike. So we had already unwound the higher yield move from into May timeframe, June, and on the yen carry trade unwind. So when this was moving higher, the yen was moving higher with bonds, by the way, we were actually having the 10-year crashing down with oil. And it was actually very dangerous for equity market. It got to a point where it was quote unquote outside the Goldilocks zone. I have a zone 3.8 to 4.5 in the 10-year. So we crashed down to 3.6, and it was literally the day before Fed was to cut, and they cut 50 basis points on September 18th, 2024. And I wrote that morning, it's time for a yield spike. I know that seems counterintuitive, but that was their way of literally policy intervention, not 25 basis points, by the way. They only gave the market like 1 week and a few hours notice. Like it was a big surprise. They were in the blackout period. The Fed Whisperer came out with the Wall Street Journal and basically said, they're actually thinking about a 50 basis point cut. And they did. So that actually helped support the reversal in too fast rate of change in the 10-year crashing. So they supported it. We got back into the Goldilocks zone. We climbed all the way up from 3.8% in the 10-year, all the way back up into 4.1, which was really very, very sweet for equities. That's really, really nice area for equities. And then it got a little higher, and it's got a little higher. Now it's 4.7. And we're going outside of the Goldilocks zone. And that's going to be another reason why the market's been going sideways for 2 months, not moving post-Trump election, because they're like looking, going, hey, did you notice what just happened to the 10-year? We went from 3.6 to 4.7 in a very, very short period of time. And that is another worry that the market is not pricing in right now. How are they going to tap that down? Because it will prevent a lot of, animal spirits if it gets and stays above 4.7.
Well, it seems the bond market in a number of these different countries, the government bonds are voting, the bond vigilantes are kind of voting that the yields were too low. And now you have yield spike, in Germany, France, Japan, the yields have spiked substantially. And then the Bank of England or the English gilt. So these, the longer duration bonds, 10 years or longer in these government bonds in a lot of the different G7 countries, it's a very common theme now where in the bond market, the yields are spiking. I think the central bankers are confused because they're like, we just cut rates and now the yield curve is steepening and the bond market is telling us we're not doing the right policies.
Well, I don't know if I see it the same way, but I can see why that would be consensus. December 12th, I also put another kind of double down. It's time for another yield spike. And that was in large part because I saw what was happening with the 10 and 2-year yield curve bear steepening, which means that the 10-year bond is falling faster than the 2-year. So this is where we're at right now, which is term premium is rising because inflation is a little stickier. All the data that comes out that shows anytime that inflation is a little stickier than expected, like recently we had ISM prices and they were very hot. And so you can see the yield, move higher. And this is the bond. It's kind of it's a mini duration shock where the rate of change in the inflation does not match the central bank, efforts, let's say. So that's why the market should be worried. And it's actually surprising that it's not doing anything about it. But I think it's hard pressed to price in what Trump is going to do about it, what Scott Bessent, the new Treasury Secretary, is going to do about it. We would know with Yellen and Fed, with Powell. It was always a coordinated, Fed's got our back. It's definitely going to be short duration bills, not longer duration notes and bonds to fund the fiscal. And that, by the way, matters because that directly relates to liquidity. So one is putting liquidity into the system, one is taking it out. Bessent wants to do longer duration. It's more responsible, but it takes liquidity out. So again, I think we're going to have a lot of headwinds in 2025. And what they're hoping for is that tax cuts will make up for it. Efficiencies, right, will make up for it. Government spending will be curtailed in efficiencies. And of course, this exorbitant privilege that we have of the dollar. And of course, tariffs supposedly are going to just right all the wrongs. It's a very tough needle to thread. I think it's going to be full of drama, actually. And that doesn't even consider all the war vibes. It doesn't even consider the health scares. So what we're talking about right now is the recession risk, when pulled forward, triggers a growth scare and bonds get supported. So one of the things I actually wrote for clients recently was, okay, we're at plus 45 in the 10-year, 2-year yield curve. We've got 3-4 months until I think we're going to start to hear a lot more about weakness in the US economy. When we get to 0.9, positive 90, that's when you buy bonds, because that's when recession risk is going to get pulled forward. So I don't think have to worry for Q1, but I think starting Q2, it's going to get very muddy. And then I think it's going to go downhill the end of 2025 for all the reasons we've talked about.
And you said that the new Treasury Secretary, he wants to term out the debt. So he's looking to lock in longer duration U.S. Treasuries, to 20 or 30 year at a lower interest rate compared to what Janet Yellen was doing when she was there.
And we have the benefit of having no idea how the market's going to, we had the benefit of knowing how the market was going to react in past years when Yellen did that, because it was also in coordination with when the Fed would cut or pause or what have you. We don't know moving forward how the market's going to react to Bessent and this new policy approach, especially when there is kind of a disgruntled Fed chair in the way until May of 2026. We don't know. The market does not know. The market does not know how to price this in. None of it. Not the policy changes from tariffs to immigration, not the BRICS effect on the US dollar monetary, military, hegemony. There's nothing. We have not priced in any of it because we don't know. Any leverage. We've got massive leverage, but I'm talking about concentration risk unwind, a yen carry trade part 2, inflation, from these policies that are coming down the pike. All of this is completely, we don't know yet.
Well, you also have base case for interest payments on the national debt for almost 15 years. There were only about $300 billion when the Fed did close to zero interest rate policy. It was only about $300 billion per year in interest payments on the national debt. When Trump took office, I think the first time, 2017, I think the national debt was like 16 or 17 trillion. Here we are, it's 36 trillion, not many years later. So,
and that's actually a really good point, because that's another reason why global central banks are cutting rates, because they have to finance this incredible deficit that they have respectively built, right? It's not just US. It's all over the place. And these rising yields are hurting their ability to pay interest, and that takes money away from more productive uses of money. So this is another issue of why they're cutting.
Yeah, I agree. I mean, I think Yellen was begging Jerome Powell. I think that was one of the reasons she wanted, some relief for the interest payments on the national debt. But then the yield curve didn't go the way they expected. And that's why you have the Federal Reserve economists, the Board of Governors there, they're fighting over the speed of the next rate cuts because they're not sure with the real economy inflation data, but they're also worried about like all the interest payments on the debt and how big a budget deficits Trump's going to run and what the tax receipts are. So now they've just made a mess of things. Meanwhile, what the base case is $1 trillion per year in interest payments on the national debt. And that's like a base case. It could be higher than that going forward.
I know. And this is where the rubber meets the road. Is he wants to tap down the dollar, but not too much. He wants to tap down interest rates. He said on Tuesday they're way, way too high, but not too much. This is going to be the needle that he tries to thread. But I still think that there is a bullish backdrop for Q1. Q2 is going to be a lot muddier, and the end of the year I think is just going to be an unmitigated mess because it will not be smooth. And I also think that the dollar is going to be at the focus of this. There's policy intervention that when it comes in, it definitely helps to suppress volatility. But I chart this stuff. It also suppresses, or I should say, reverses the ascent of a dollar and yield move. So it's very, very effective. But the dollar itself is going to be really hard to reverse moving forward. I think yields are going to be very hard to reverse moving forward. We just talked about this, right? They want to cut, but then inflation comes in. And then
so they're trapped. They don't have good options. It's like fiscal dominance, yield curve control. So we're basically at the point now where it's a trillion. No matter what they do, it's what the base case now, almost no matter what they do, is $1 trillion interest payments on the national debt. And you're saying if they get it wrong, it could be way higher than $1 trillion payments on the national debt.
But they also cannot do, I mean, they can, but they can try, but I think it's going to backfire terribly, is a QE, because this is very inflationary, and they don't have the power anymore. They don't have the levers anymore to do, they've done some stealth QE in the background, right? And they've come out with some policies to help banks, keep credit flowing. They do that all the time, by the way. End of the year, New York Fed came in with $500 billion because there's always interruptions, at the end of the year and such. But the point is they have a way, they do have some levers, but I'm talking bigger picture on, policy intervention and how it's going to, what form it's going to take, the effect on market liquidity and corporate refinancing. We haven't even talked about that. I mean, refinancing is going to be a bitch. This is going to be a very hard fight with Besant, changing up, longer duration maturities, shifting to that. At the same time, corporate debt refinancing is going to start to hit in late January. They're hitting the proverbial maturity wall. So it's very likely that we've seen the low in credit spreads. In other words, the tightness, they're going to start to widen, is my baseline bet. Of course, this all kind of stacks up together. Really bad timing, of course, but it does stack up with, earnings that'll probably be soft for Q1. The corporate refinancing and the hitting the maturity wall and the high yields and the high dollar. But the dollar, I think, is going to be the toughest one for Trump to manipulate. And it's a game of, he's damned if he does and damned if he doesn't. He warns all the other nations not to mess with the dollar, state of exorbitant privilege, right? This hegemony of dollar and military might is very, very overvalued relative to peers. And a lot of the other currencies are also political currencies, the yen, the euro. But he the point is, he's going to have a really hard time convincing them not to trade amongst themselves, for example, if his goal is to boost U.S. exports, to support U.S. exporters. It's going to be very tough to shrink the U.S. trade deficit and still remain, on top of this very, very special heap. But he also warns them not to mess with the U.S. dollar while he's threatening tariffs and trade policies that are going to create a bid in the dollar, because the peers, right? China is going to continue to devalue their yuan and et cetera. And the economy in Japan is not strong enough to have a strong yen. So we're still going to be fighting this economic malaise in other locales, which is why their currency is falling. And on top of that, he also says, come here, we've got this great country, invest here, buy our dollars. But at the same time, foreign holders are going to start to demand fewer, not more, right? The BRICS is becoming stronger, not weaker. This is also a time where I think we could get some global instability, and that is also another bid in the dollar, right? Risk off into the dollar. But ultimately, all of this is about, right now, short term, a fabulous place for foreign countries to invest, race for dollars, because we've got these U.S. companies that are just crushing it. And the problem is, for the U.S. companies that derive revenue abroad, it's hurting the margins. So revenue abroad plus tariffs plus inflation plus rising dollar and yields, it's going to come out eventually in labor shedding. It's going to come out in disappointment by the market. I think they've priced in a lot of future growth. They need to price it out. if we do not get what we are promised on the campaign trail.
What I also see with the Mag 7, the big tech companies, they're committing to these enormous capital expenditure projects for data centers, artificial intelligence. I think Amazon just announced in the last couple of weeks another $80 billion that they want to spend. It was either Amazon or Microsoft. I think it was Microsoft actually, but Amazon is committed to. I think it was Microsoft was committed to that. And now Amazon has a similar, I think Amazon's even going to spend more than that. I think it might be 150 billion over the next 12 to 18 months for data centers, artificial intelligence, cloud computing. And there's no guarantees of profits. So they need to start building what they want to build out this new tech cycle here. This is 2025 and beyond. This is not just for the next 12 months. I mean, we're talking the next 5 or 10 years that they're laying out, because with the new presentations from the CEO of Nvidia, Jensen Huang, at the Consumer Electronics Show, other tech conferences he's talking about the next 5, 10, 15 years of all the investments that need to get done to lay the foundation for the next technology cycle with what data centers, artificial intelligence, and in robotics.
And this is a good question. And I'm not, tech focused, as you know. I cover cross asset classes and multiple time frames. I mean, I run a live trading room, so I'm very focused on short duration as well as looking ahead at risk. So for our purposes, you're talking about the opportunities, but when we do come into macro headwinds, which I think are going to be front and center, especially second half of 2025, CapEx and the rest are going to kind of take a back seat, or they're kind of going to regret. So I think for right now, I'm more interested in this kind of AI digestion phase that you just alluded to with Jensen saying, hey, we got many years to go. So how much can Nvidia grow revenues without all these hyperscalers growing their CapEx, right? You talked about it's starting actually to level off. So it was very robust from Q2 of 2023, and it grew 50% by the end of 2024. But their predictions of moving forward, it's less. They're, I think, going to have a little bit of AI digestion, which could also come at the worst time as it relates to earnings coming in for, this expected growth rate. In other words, expected growth rate of 50% per year by Nvidia past 2 years is going to be near impossible to maintain moving forward. Once we go through this digestion phase, we can revisit. But for right now, it seems like this is a little bit too much forward growth pulled, future growth pulled forward that still has not manifested itself in real productive use of money.
Yeah, I was actually going to say that maybe I didn't explain it well enough. That my point was that like Microsoft, Amazon, Google, they're going to be committing to many billions of dollars. They're talking about they're definitely going to spend it. There's no guarantee they're going to get any profits from any of this. So they're going to keep spending like billions and billions and billions. And maybe Nvidia is going to be selling them the chips, or some of the other manufacturers, Broadcom, or some of the other guys, whoever builds the data centers, whoever builds the natural gas pipelines or solar panels to the data centers. But the big tech companies, so like Microsoft and Amazon and Google and those guys, there's no guarantee of profits here, but they're still going to be spending billions. So that's like, I think the point I wanted to make is that, yeah, these companies are immensely profitable, some of their other businesses, but they're going to be throwing lots and lots, many billions of dollars of CapEx at data centers, artificial intelligence for Microsoft and Google's quantum computing. And there's no guarantee of any types of profits, but the CEOs and the executives seem committed to throwing billions of dollars at this.
Well, that's what they do. And we got a new, hot thing, and that's perfectly fine because they're committed. And this is their job is to have a vision and to follow through with it. And by the way, they're filthy rich. They have got tons and tons and tons of cash and tons of financialization of their stock price. So really, it's a closed circuit. They are obviously in a very small club. We're not invited. And they have the means to make all of this possible, right? Also invest in energy alternatives and nuclear renaissance. It's fabulous. We're all going to be beneficiaries of it, we hope, right? AI doesn't, turn dark. But the point is, this is going to be over time. A lot. There's going to be real, and then there's going to be perceived, and the market hasn't really figured all that out yet. But I will say, once we hit a macro headwind of the stuff that we were really focused on, which is dollar and yields and new policies, which will dictate the market, liquidity, and then of course the bullish bearish bent of what happens if the economy does start to falter, which is what my indicators are pointing to. And I've been waiting, like we talked about this in June of last year, and I said I don't see it until the end of 2025. I still see it the end of 2025. So nothing's changed. So I think we have some work to do in kind of balancing the reward of all of this excitement of this new technology, transformational for in every regard, with the actual slowness at which it will be rolled out. Right, the deployment is completely different than the manifestation of the vision, and then of course how it's going to affect the real economy. So that doesn't happen overnight. Neither did the internet in 2000. So it's very exciting, and but for me, it's a closed circuit. They're just feeding each other the revenues and the orders, and it's because they have the ability to, and the rest of us are kind of watching to see what's going to be made of it. But in the meantime, I was told it's not a closed circuit, Samantha. It's a keretsu. It's like the Japanese keretsu, where they're investing in each other and they create this monopoly. This really a closed circuit. And we have to just, for me anyway, I have to really kind of discount that. I hate to, because it sounds so exciting. Everybody's so excited about it. But my common sense says this isn't going to matter when we have an unemployment rate that goes above 5%.
Well, you already have big moves in the stock prices like Nvidia and Palantir. I mean, Palantir is up enormously for the last 9 or 10 months. So some of these Broadcom, some of these other plays are up enormously. Anything with artificial intelligence in its name up enormously, except for the accounting scandal at Supermicro.
Yeah. Yes, this is another thing.
But I would say contrarian play. I would say contrarian play because you have Republican Congress, you have Trump in the White House. I would think like the natural gas pipeline companies building a pipeline maybe from the Marcellus and Utica Shale, in Pennsylvania, West Virginia, say EQT, building them to the data centers, pipelines, and natural gas. I think that might get approved. Whereas if the Democrats were in Congress, control of Congress majority, and in the White House, that might not get approved. So I could see like natural gas, liquefied natural gas exporters, natural gas pipeline companies to the data centers. I could see natural gas and energy being a beneficiary of all this. I think that could potentially be profit increases. Do you see any other industries that might benefit from Trump and a Republican majority in the White House?
Oh, it's a really great question. I like your call on the nat gas only because I have a few clients that are extremely focused on that. So they're subject matter experts. I'm not. And that's what I tend to do is I lean into those who are subject matter experts. And so that's definitely one area of interest. I would say that the problem, of course, is there are many. It's still going to be, with oil anyway, headwinds regarding if we do pull forward this recession risk and global demand falters, right? And then there's EV and that, huge thing. The risk actually of oil falling could be a little short-term stimulus for consumers, but it is seen as deflationary and recessionary. So then that makes it very hard oftentimes for investors to really get excited about oil and gas. So that's the caveat I should say. So yes, I agree. This is very focused on the data centers, I know, and feeding them. And we've got plays including EQT because of a client who is extremely well versed in the space. But I would say that this is all going to have to be buffered by what I see from the macro landscape, which is going to take priority and preference over any sector rotation. So we've talked about gold and silver, for example. You're so well, oh my goodness, skilled in the miners, your level of fundamental knowledge about that whole space. So the commodity space, but miners in particular, it's still going to be very tough to get up and go since they run a very high beta, right, with equity performance. Very different from the underlying of gold and silver. But the point is they're still oversold, unloved, undervalued. But they're going to have a hard time getting that investment momentum. I don't mean stock. I can buy EQT with options, or I can buy Newmont, for a few weeks or months. I'm talking about investors, real interest in the commodities themselves. And right now, unfortunately, a lot of money has been flowing into Bitcoin, which is like an exit ramp to productive use of money. Instead of going into investment of things and people, into commodities that produce value for Americans, it's going into the speculative, easy money assets of Bitcoin and crypto and NASDAQ for that matter. So that's the problem. We have to break that in order to really see a change or a turn and an investment in the commodities that you know so well.
Yeah, I mean, the fundamentals of some of these miners, like Newmont's not a good one because they keep having their cost ride. But Agnico Eagle, for our listeners out there, I mean, they have the two lowest cost producing gold mines there. They have over $1,000 an ounce free cash flow margins, two of the lowest cost producing gold mines. The market doesn't seem to care. The market's like,
point. Yes, that's my point. So you're spot on. You know that how unloved and undervalued they are. And I would also make a case. I have a subject matter expert on China. He's one of my contributors, and he's a classical economist. He's like, oh my God, the media is just bashing China, and these plays are, Baba and whatever, are so amazing, like ridiculously undervalued relative to the US overvalued Mag 7. But it doesn't matter unless money flows into that space. That's what I look for. I look for the money flow. And this is the problem. There isn't an alternative right now. There will be. But I think we actually have to upset the apple cart, hint, hint, pun intended, in order to get there.
I don't know what the apple cart reference is.
Apple.
Oh, Apple. Oh, Apple's ecosystem. I mean, Apple's like T-Mobile. T-Mobile just is giving away like the brand new iPhone, the iPhone 16 Pro. Like you can trade in your old cracked iPhone now and get it. I think like my mom and my sister just got like a brand new iPhone 16 Pro for like $50 shipping fee or something. Yeah, they're literally just giving it. I just got an email from Best Buy saying that MacBook Pros are $800 or less now, brand new ones or something.
But we know that the price is elevated and exorbitant as it relates to the the earnings for Apple. So, but it's incredibly difficult to convince traders to transition into oversold. There has to be a trigger, and in the case of China, it requires fiscal stimulus to get those Chinese ADRs up off the ground. It requires the Trump trade wars to be in some way dealt with, right? So they're not an obstacle, and none of that exists. Oh, and also their own citizens to be interested in the stock market, but mostly we don't have this rotation right now into another sector. Not staples, not healthcare, not China, not oil and gas, not metals and miners. So all of those quote unquote value, they're not quote unquote, they are value plays, are not in season. The only time they will become in season is when the Mag 7 concentration risk unwinds. That's it.
Yeah, that's a good point. But what we're seeing with the management team, Samantha, the management teams of some of these companies, I mean, Agnico Eagle, since I talked about them, their management team went and bought like a junior miner with all the land right next to their producing mines. They got it for pennies on the dollar. You've seen almost $250 billion in oil and natural gas deals of mergers and acquisitions. So you are seeing the management teams of these companies look long-term and make smart moves, go and buy assets that they think are cheap. So yeah, their stock price is not being recognized for it now, but a couple of years from now, that cycle will turn when that sector rotation you're talking about, the management teams are going to get rewarded then a couple of years from now.
Yep. And that's what they're pitching. And there are folks that are patient. And then there are, of course, the day traders, the zero DTE option slingers. But I'm just watching it all. Like this is fascinating to me. I'm looking at my analysis from the macro standpoint of what the risks can be. We haven't even talked about war vibes and health scares.
Well, look at the day traders on Robinhood app and Coinbase and stuff like that. I mean, there's people like gambling on what these altcoins, what Fartcoin and some of these other meme coin, the market caps on these things had billions of dollars.
And so that's what I mean by there's way too much liquidity right now going into all kinds of unproductive spaces. So that's what has a habit of changing very, very quickly when recession risk is pulled forward. So they will not be in a situation to frivolously, think of capital as disposable. So we're not there yet. And I'm suggesting, as I said in June when we last spoke, that I can see the second half of 2025 getting us closer. So it'll be a very different market. I think folks, they think they're really smart because they made money because it's a bullish, run. But now they have to figure out, okay, so what do we do when this changes? And what do we do when this changes and there's a recession? And they haven't figured that out yet because a lot of folks came in post-COVID. So that they really have been, mother's milk has been speculative assets.
And they trade in their phones too on either Coinbase or Robinhood app now, yeah.
And there's nothing wrong with that. I mean, this is great that we have, because I know it's great because I run a service, right? So I'm actually chase swing trend, macro and micro, retail and institutional. So I love to see it all. But I've also seen a lot of women come into the space and they're more risk aware. They want to build wealth. So, and there are lots of folks that I have as clients that already have wealth. They're very sophisticated and they just want to, protect it. So I think that there is a lot of emphasis on this momentum gang, but that's not really the core. The core is institutions. And then there's a lot of wealth that is, by the way, all-time high wealth in equities for Americans, right? It's like 43% or something. It's like we're really tied. The stock market is the economy. So if we do have a pullback in the stock market, it is affected in everything from tax receipts to jobs to household wealth. It is absolutely the wealth effect. So we have not had any pain, and this is what I'm afraid is going to actually start at the very soon this year.
So if we do have a recession, historically, you're thinking then normally the asset class of sectorization, you're talking about what, consumer staples, utility stocks, although those have a growth component now with the data centers that are being built with the electricity demand growth usage that I've been talking about for the last 12 to 18 months. And then what bonds, US Treasuries, people normally buy what longer duration US Treasuries, although maybe they'll go shorter duration US Treasuries and gold. Is that normally the asset rotation that you get in a recession?
That's normally, but right now there is no bid, no reason to buy bonds. They just continue to fall. So this has been one of my big themes since August of 2020. I said bonds are done going up. There was a huge outlier event in my intermarket analysis. There was a huge rate of change in the speed at which yields started moving up off the bottom, not since Civil War times. And I said, that's it. They're done. They're done going up. I didn't know that it was going to turn into this historic 3-4, year, reversal, but it did. It is done. We are typically in a state of deflation. So that's why bonds have done well. In the current situation, yields are moving higher until we get a recession risk of that takes a bid, like I said, that 90 on my 10-year, 2-year yield curve, that takes bonds and actually brings them to the forefront again. That's when they actually make sense to buy. But honestly, we're now a broken trend. So by that, if you're, technical trader, we got a trade in bonds for 40 years that ended, and now it's very volatile. And in a few years, we'll probably still see inflation moving higher and yields moving higher. But this nature is going to be disruptive in the short term, in the next few years. The only reason to buy bonds is because we get that recession risk starts to come forward and we get a deflation scare. Right now, we don't have a deflation scare, right? So it's really when the Fed starts to get deflation phobic and they start to cut rates aggressively. I mean, deflation phobic. They're not right now. They're doing normative rate cuts. Very different. And inflation's still very sticky. When they start to become deflation phobic and do aggressive rate cuts because they're accommodative, that's when bonds get a bid. Does that make sense?
Yes. Well, I think inflation's not going to go away. I think, unfortunately, I see a lot more. I don't see the government's wanting to fully cut back. I mean, the Department of Government Efficiency is talking about cutting all this waste. It's going to be easier said than done. If there are any problems, like you said, with the economy, I see the government wanting to do, there's some type of stimulus or jobs program, maybe social spending program or an infrastructure program. Not that any of these things are done efficiently. They're mostly just wasteful here in DC from both political parties of Congress and the White House.
And there is another factor that I'm thinking about, and I've talked with, I have a wonderful classical economics advisor on my team. And we've talked about how he's not so worried about, a big bond shock or recession risk. So I'm way, this is all me. I'm way trying to predict the future here. But we do agree on one thing: higher prices amidst an economic slowdown.
That's stagflation, isn't it? That's
yes,
more or less stagflation.
Yeah. So we and regardless of who took office, by the way, we were talking about this long before I made the bet that Trump would, be elected. It was very much, they can't put this back together. They do not have the levers to pull anymore. So if Trump, however, can really deliver on cutting war spending, corporate welfare programs, remove a big chunk of this, fiscal deficit that's just pork and unproductive, then maybe we'll revisit that. But for right now, this is very much an economy and very much corporate earnings and very much corporate consumer spending that have been financed by the government printing money, by monetary policies that have been suppressing volatility and rates for quite a long time, by QE. So we don't have price discovery. This is going to be what I see as the one good thing about the disruption that can come to the stock market and the economy is that we could actually have a chance at price discovery. I'm talking price discovery in assets, because when you get price discovery in assets, you then have all this, the speculative, some would say garbage like fart coin, but I would also say Bitcoin, which is going to come out, and they're going to have to be very careful about the use of money. Right, the productive use of money. Capital will no longer be so disposable, and that will actually create a lot of investment that we need. So that's the one good thing that comes out of it. But we got to get through there. We got to get through it first. And right now, everybody's still on the sugar high.
Well, I mean, Congress says that they're spending money on infrastructure or these other things, and then the money's just wasted or it's not spent at all. So, I mean, they add an extra 1,000 pages to the bill, and the average person is not going to be able to tell any of the stuff where the money is going or what it's being spent on. So, if they reduce the bill down to 5, 10, 20 pages, made it streamlined, the average person could read the bill and understand it. There would be less loopholes to sneak stuff in. I got in an argument with someone saying that even if they reduce the bill down to 20 pages, they could still hide stuff. No, they couldn't, because the average person could read it. If it was 10 or 20 pages, they would read it and they would know back and forth some of the stuff. There would be less stuff to hide it in.
And the same thing with the IRS, tax code. But these are all lots of promises, and we will hope that some of this stuff comes to fruition. But for right now, the market has a really hard time pricing it in, which means they have a really hard time making investments and determining, hiring and all of that. So if this doesn't go as smoothly, then do expect some surprises, some bumpy unwind in equities before we can get a real rotation into things, that matter. And in the meantime, we also have to keep in mind that we have 17% of equity holders are foreign. So that matters. That's a contingent that
you mean foreign investors holding NASDAQ 100 and Mag 7 stocks,
correct.
S&P?
Yes.
Okay.
Yeah. So if we do have any type of devaluation of the dollar under Trump, which is something that they have both, talked about, JD Vance and Trump, repeatedly, but they don't want to lose the exorbitant privilege, but they want to devalue the dollar. It's too high and rates are too high. Well, then that can become very bearish for foreign holders of equities. And that could be that trigger that also causes that money to go home. In other words, they leave, they rotate out of the dollar and they sell U.S. assets and take their money home. So there's a whole bunch of stuff that kind of comes into, it's more complicated. It's just not so inversely related that one policy is going to do this. It is interconnected in a big way, but most of it centers on dollar yields and oil right now. Oil's not really a headwind. I don't think it's going to be such a big one, but I'm definitely focused on the value of the dollar, nominal versus real, and of course, yields, where they're heading and how they're going to suppress them. In the meantime, we make hay while the sun shines as it relates to equities, but definitely, I don't think this is a market to be complacent It's not like, Fed and Yellen and the White House had a coordinated message. They had coordinated efforts, and it was absolutely to keep the economy let's gaslit, but also the market
Stock market juiced.
juiced to get their man elected or woman elected, and that didn't work out. So I think we do not have a clue what we.
Well, they
really
rigged the jobs reports too. Look at all the numbers they revise downwards every month for the last 12 to 18 months. Pretty crazy.
It's really hard to believe any of it, but we can hope that we actually get real data. Like I said, we have a chance for price discovery, for data discovery. This is exciting.
Well, let me ask you one more question. So you laid out a lot of risk, a lot of uncertainty there, and you said they have to thread the needle. So that's it sounds like a very low probability they're going to thread the needle. Trump's first term, the gold price went up over 30% in the 4 years he was in the White House. The gold price right now in US dollars is holding up relatively well, despite the 10-year US Treasury yield looking attractive to investors at 4.7%, relatively strong dollar. Gold price still above 2,600. Do you think then by 4 years from now, we could see the gold price way above $3,000, considering that like the last time Trump was in office, it was like weak dollar, relatively weak dollar and inflationary and still ran $1 trillion budget deficits?
Yeah, when Trump came in 17, for the first 2 years, he was successful in talking down the dollar, but the other 2 years, not at all. In fact, it went right back up. And remember, this is a slow moving vehicle, but for the most part, yields did not fall. In fact, they continued to rise right into October 3rd, 2018. No, I've got the right date. I've got the right date, the wrong day. I'm trying to think. Hold on. 17, 18.
Powell started a rate hiking cycle, if I remember correctly, in early to mid 2018, and then it caused the repo crisis by 2019.
Correct. But yields did rise. And I remember because it was October 3rd, 2018, the dollar had fallen, but yields were still rising. So they went from like 2.5 to 3.2 at the 10-year. Anyway, that caused actually emerging market panic. Long story short, the backdrop then of fiscal dominance versus where we're at now of monetary dominance is going to have a very different effect. But his ability to talk down the dollar the first 2 years that helped support gold is very different this time. This is central bank, as you know, right? The China buying a lot of gold and settling in gold versus dollar is allowing gold to stay bid. Although October 29th, before Trump got elected, I said, I think all of my clients are extremely excited about gold and silver, right? For all kind of macro reasons as a trend long. But I said, be very, very careful for the next 2 weeks, because I think it's going to come down hard and Bitcoin's going to get a bid. And that did happen. And then I followed up and I said, you know what? I think you need to keep this in perspective, that Bitcoin is still bid. And until then, gold is going to be, the flows are just going to go there. So remember, I focus on flows. So gold hasn't had the opportunity to really get back up. It's gone sideways. It's really gone nowhere for the 2 months with the market. But I think that's another example of a very strong case for gold moving forward from a macro standpoint, but also from a flow standpoint. But it does not work well if Bitcoin is serving as the off-ramp, right, for liquidity, for inflation. They are buying Bitcoin. They're not buying commodities. Commodities, if they get a bid, it's inflationary. So that's one way that they're suppressing the real rate of inflation as well. So that's another thing to kind of, I'm still bullish on a trend time frame, but in the short term, we still need to have a macro trigger for gold to move higher.
And then in the meantime, we're talking about the tech companies with the CapEx, talking about like they want us an order of magnitude more electricity. Potentially, we start building out these data centers, the amount of electricity required for each chat GPT search or artificial intelligence search query versus using Google or one of the other basic internet search engines. I mean, we build this thing out. We're looking at an order of magnitude more electricity needed, Samantha, in the next by mid like 2034, 2035. And it seems like the commodity sector is so out of favor. No one wants to make the investments now for the most part.
That's it.
I just see a train wreck coming that the tech companies want to build this out, but we don't have the materials and energy and infrastructure needed for it.
And that is 100% my baseline bet, where I said, I actually had a post where I said, be careful what you ask for from Bitcoin. Trump's blessing on Bitcoin could backfire big time. And it was that reason that Bitcoin serves as the off-ramp to suck out any liquidity that would otherwise go into commodities in general, but just, productive assets. Specifically, it's very much an inflation suppressing vehicle. I think it is by design, by the way, not just by default. I think it is actually by design. So
you're saying that Bitcoin price going up actually moves some of the inflation that would go into other commodities or other things and moves it into Bitcoin instead. That's what the point you're making?
100%. Yep.
Well, that's interesting.
Bitcoin competes for the very dollars that could be used for productive investments. Full stop. So projects that deploy commodities, employ people, that support a higher standard of living and real economic growth. Bitcoin is the off-ramp for real things.
Have you seen the theory that Luke Gromen has for actually Bitcoin? His analysis is that the U.S. government owns a lot of Bitcoin, but the higher the Bitcoin price goes, so if the Bitcoin price goes to 250,000, the stable coin that backs it, Tether, has to go and buy more U.S. Treasury. So that creates an even higher bid.
That's also, I agree with that. I think that's also by design. Like really, this is, there's so much, not just grift, but also siphoning money away from value stocks, bonds, world commodities to the largest holders, the most wealthy owners of these speculative assets. And it's also used to kind of backstop, if that's a thesis, I think it's probably a good one to backstop U.S. Treasury because it's a collateral, right? We need to keep, in order for the dollar to retain its value, it has to be tied to U.S. Treasuries, and that collateral is important to maintain. So I get his thesis. I really do. I just think the problem is that it's an argument that shortchanges. Bitcoin is basically a vehicle that shortchanges America's ability to focus on and fund our real future.
Well, by real future, you mean actually like growing the economy productively with high-paying jobs, and that leads to tax receipts. So you're talking about like actual investment, like saying we build out like one thing that needs to happen. If we're going to build out the artificial intelligence and robotics and data centers, we need to upgrade our electrical grid. The transmission wires are a mess. The electrical grid is a mess. We just don't have the infrastructure needed to go and have this next generation of technology cycle right now.
And if this is the vehicle that helps us get there, okay, but it doesn't seem like that's really what's happening. So I'm of the opinion that Bitcoin is kind of the popular delusion and madness of our time. So it's something
the Bitcoin maxis are being yelled at now because like the other people who are making all this money off the altcoins and the meme coins are calling the right people that just own Bitcoin like you're like a dinosaur.
I honestly, I wish I cared, but it's one of those things where I just look at the motivation and it feels very much like it is an off-ramp to investing in things that actually matter. But I get their argument. I understand, that many countries and many very smart individuals are pro-Bitcoin without really knowing anything more than its psychology of it. Price just goes up. And so, of course, they're very smart to, again, it's like the bull market when you have lots of policy intervention. It's when it starts to interrupt and real macro headwinds come forward and you have to test all those theses, which ones are actually going to survive. So we haven't had a real stress test of Bitcoin in a nutshell. And the market, the players in the market that are retail haven't had a real stress test, right? Because we haven't had a recession. The one that lasted for 1 month over COVID doesn't really count. So I'm talking, we're going to have a chance. I think it's coming up in the next year, and I think we're going to have an opportunity to really show what matters. And I think we're going to have an opportunity to change this speculative fever. But for right now, we're firmly, in the grips of it and having a wild time until Trump was elected and the market decided to go a little soft, and underneath the surface they're selling, but the market's still holding up because of Mag 7. So that's what I focus on, and any of the arguments bull or bear, I'm looking at it every day. Like what's moving and why. But this projection business is hard, right? Especially because we have a new policy leader and those who are going to roll out the policies like Treasury Secretary Bessent or RFK Jr. of Health and Human Services, et cetera, et cetera. I just think it's going to be an exciting time. We have a chance for price discovery. I'll go with that.
Well, also historically, when you have like tariffs, I mean, they become retaliatory, and then you get into what currency wars, trade wars, resource wars with China threatening to, or they did put a rare earth export ban on, and Trump's talking about buying Greenland or annexing. I don't know. But I think that sounds like mostly for rare earth elements, because it's after resources, right? Because if China's going to ban the rare earth elements, our technology companies need those rare earth elements. So now you're getting into like the 1920s and 1930s again with bad policies, neo-mercantilism, and trade wars.
And that's what I actually have as a pinned tweet, that I think war is going to be a growing concern. And it has not been ever on my radar. So that's something that we haven't had to deal with either. Health scares.
Well, I don't know about a physical war, but like, I mean, we're headed towards financial wars for sure. If other countries are going to put retaliatory tariffs on and protectionism, and then, threaten to ban what key natural resources.
Well, I think we could actually have both. And that's something that is not really on the radar, because it's very hard to predict or honestly time. What is easier to predict is that it's too expensive right now. The cost of borrowing is high, and that's going to start to hurt the private economy. We can predict that, the global credit demand is falling and jobs will suffer. We can, predict obviously that interest payments are burdensome for a government, and that's why they're cutting into inflation. we can predict a lot of things, but not necessarily the timing of an act of war. But right now, the economic war has not even picked up speed yet. But you and I agree, this is going to be another reason to hope that there can be some peace and resolution of trade wars, so that the tariffs don't take a big bite out of our kind of market equilibrium, which right now has been firmly defended by policy intervention, liquidity, and a very bullish option market. So if any of that changes, those are the three legs of the main table I talk about, then we will have a very different market. We'll have a two-way market.
I want to thank you so much for your time today, Samantha. My listeners should definitely check out your trading room there at Leduc Trading. I fully agree there about your point about debt refinancing. I think it hasn't impacted the real estate market quite yet, because home prices in a lot of areas are still pretty strong demand. Although I guess like the younger adults my age or younger are not able, unless they're getting financial help from their parents or grandparents or something for a down payment, they're not able to qualify for a mortgage at 7% or higher, even if they have a perfect credit score. So and then you have commercial real estate at these higher mortgage rates. So I think eventually that will play out if interest rates stay at these levels. I think real estate is going to be very affected.
I don't think the price will fall as sharply, though the value of homes will fall as sharply, anywhere near as sharply as they did in the great financial crisis, just because the wealth of the homeowners and the nature of the mortgage debt. Affordability is a mess, so that could definitely help. Obviously, if we get some weakening in the economy, but I'm not worried about a big housing crash. And I know lots of foreclosure bros, I guess they're called, on YouTube and the rest. They're full of it. They don't really understand that mortgages had a much higher bar after the GFC to even get in, and the wealth is greater. And those that are the mortgages that are paid off versus those are at 4%, 5%, 6%. We're in a much better situation. The problem is we still have an enormous amount of wealth tied to the stock market return. So that's where we have to kind of be careful, because that will impact the real economy for sure.